What's going on, YouTube? It's Andrew, the Frugal Crab, back with another review of Disney. We're doing a review of how to roll an option. Had somebody request for me to go in an in-depth video on how to do that. So, of course, I'm going to go ahead and show you guys how to do that today. So the one we're going to look at is Disney. That's one that I have currently. I've already done a roll on it before, and I'm possibly going to do another roll in the future. Just depends on how the stock continues to trade. So, of course, guys, just want you to take a look at this and see how things go. If you do have any questions or if you want me to do a video, please leave a comment below or send me a message. Again, these videos are for entertainment purposes only. I am not a specialist. I'm not a stock trader. Again, this is only to help show the possibility and the money that you can make trading options. Again, you can follow me at the Frugal Crab. And again, if you can hit that like button, subscribe, I'd greatly appreciate it. Let me know if you like these videos. So with that being said, let's go ahead and get into it. All right, so here, guys, you see Disney. That's the stock that we're looking at today. So of course, you can see right here the total market value. You can see the average cost, total return. So about 12-13%. Right down here, it shows you today's total. This is the current option that I have, my covered call at the $92 strike point for December 22nd. So of course, guys, if you don't already know, if for whatever reason Disney is over $92 at December 22nd, those shares will get called away from me at that strike point, which is $92. Now, as you guys can see, my cost basis is right here, your average cost. So regardless in the situation, as I teach in the double dipping strategy, you're going to make money regardless of what happens at this situation. Now, if you just, for whatever reason, want to keep Disney long term or you believe in the company, then of course that's where we want to roll this option so it doesn't get called away from us, right? I do have stocks in my portfolio that are like that. AT&T being one of those examples that if for whatever reason, if I did have a covered call on it, which I don't, but if I did and it did go past my strike point, because I want to keep those shares, I would 100% roll that option. So I'm going to go ahead and show you guys how to do this. So if you come over here, you can see the buy and the sell. Buy order, dollars amount, estimated quantity. So what we're going to do is we're actually going to go to my original call. So right here, you see options. So we'll click on that one. It shows you my total return. So right here, it's down 30%. And that basically just means if I were to buy back the option, I would be losing money. And this is the amount that I'd be losing in addition to what I might have already lost previously. But of course, we don't want to lose any money. So we're just going to either let the option expire on December 22nd or we're going to roll it. So right over here on the right, you can see roll this position. Over here at the option chains, it gives you a couple of options. So whenever you do roll an option, you do have the choice to either roll it further out or you can roll it up or down. Rolling up meaning increasing your strike point, rolling down meaning lowering your strike point. So in this situation, my original strike point for the call that I have is $92. If you guys see right here for the closest one that they have selected, which would be the next week on the 29th, you have the option of doing the 95, 96. So if I wanted to roll it up because Disney has been trending up over the last couple of days and last couple of weeks ever since their earnings, I could select the $96 strike point. But as you guys can see, I would have to pay $247. So we don't want to do that. So let's go a little bit further out. Let's say we go to February. The $100 strike points, $3.40. I'd still have to pay $160. If you roll it down to 95, well, then you have a credit of 80. And this is also a possibility because it's been trading within 94, 95. What would happen if I were to go this route and I did pick to roll the option out till February 16th, 2024, basically 83 days? What would happen is I would get a credit of $80. And if, for whatever reason, Disney was below this strike point, I'd be able to keep my shares. If it was above that strike point, I'd have to sell it at the new strike point of $95. The biggest risk whenever trading or selling options, whether that's a put or a call, is your opportunity costs. So all of that money that you have tied up in Disney, you're unable to use until this option has been taken care of. So that's always something you got to consider. Maybe there's another stock that you want to purchase or you want to use your money to purchase or do another option on. So let's just say maybe come February, we have other options that are more lucrative or worthwhile, maybe Tesla, maybe Amazon, whatever it may be. You're going to need that money or that capital to be able to do that. So that's why if you don't want to hold the stock long term, I would advise at any point in time, if you can buy the option back, buy it back, or allow it to expire and let those shares get called away from you. Okay. So in this situation, if I want to go even further out, let's just say Disney is a long-term play. I can go almost a year, almost 2 years, sometimes three, depending on what's set up. That's the longest you typically can do. So let's just say I want to go at least a year to September 20th. As you guys can see, it's a much bigger premium. So of course, I could raise it even higher. I could say the 110 strike point, get $30 back in a credit. But again, it means I have to hold that option for at least a year. Now, the goal is never to hold the option for a whole year. If we ever have an opportunity to close that option early, typically we're going to go that route. And the reason why is we want the flexibility to be able to do what we need to do with our capital. So whenever you have that opportunity, you should try to close your option at all cases. In every situation, if it comes up, you need to close the option, especially if you're going to get a profit from it. Now, in this situation, I'm kind of a little behind in terms of the fact that I've already rolled it. Yes, I receive a credit, and at some point in time, you can close it. Again, what would end up happening in order for me to close it is Disney, the shares would actually have to go down. So that's why I said it would need to be a long-term play. It wouldn't be something that you plan on selling right after because, again, you're going to lose money because the stock's going to go down. So you don't have that option. So with that being said, let's just say I did decide I wanted to select the $100 strike point, believing that Disney's not going to go any higher. I can select that. This is going to be a year out, 300 days. And as you can see, the total credit would be 423. So that would be $423 in your pocket. And even, as I said before, even if Disney in a year, September 20th, 2024, is at $100, let's just say it's at 105, you're still going to make money because you bought the shares at 85. So you're not losing anything, especially if you have no problem or issue with selling it. The only thing that you're really missing out in that type of situation is opportunity costs. If the shares of Disney, for whatever reason, did drop, what would end up happening and the strategy that we employ, the double dip strategy, is you would just simply buy this contract back because it's going to go down in value because the price of Disney went down. And then all you would simply do if it's a long-term play, you could just simply either buy the shares at the lower price and lower your average cost, or you could then sell yourself a put and collect money on the downside. So again, you have options. Like I said, you'd hit continue. After you hit continue, it'll say review order. It'll tell you the number of contracts. It'll give you the estimated minimum credit. You'll hit submit, and then you would go from there, right? So like I said, guys, if you want me to do a video in the future over something else, whether it's a stock that you want to trade or one that you believe in, or you just want me to cover a future or past trade that I might have done, please send me a message. Hit that like or subscribe button. Let me know that this video or these videos are helping you out. Again, we're here to help you guys make more money, make more income. And that's really what I'm doing options for. So again, guys, appreciate you watching the video. Please hit that subscribe and like button, and I'll see you next time on the next video.